What's up, finance insiders? Welcome back to the channel where we break down complex financial topics into bite-sized pieces to help you level up your money game. Today, we're tackling a question we get all the time. What's the difference between ETFs and stocks? And what about mutual funds versus a Roth IRA? Stick around because by the end of this video, you'll be able to confidently navigate these investment options like a pro. Before we jump into the differences, let's make sure we're all on the same page about what these actually are. Stocks. Think of stocks like slices of a company pie. When you buy stock in Apple, Tesla, or Google, you're essentially becoming a part owner of that company. You're buying a tiny piece of their business. Now, the value of your slice can go up or down depending on how well the company performs, any exciting new products they launch, or even what's happening in the overall economy. ETFs, exchange-traded funds. Imagine instead of buying one slice of pie, you buy a whole bunch of different slices from different pies all at once. That's kind of what an ETF is. It's like a pre-packaged basket of stocks. ETFs usually track a specific index, like the S&P 500, which includes 500 of the largest US companies, or they might focus on a particular sector, like technology or healthcare. So, with one ETF, you can instantly own a piece of many different companies. Diversification. This is a big one. ETFs are inherently diversified because they hold a collection of stocks. This spreads your risk around. With stocks, you have to do the work of building a diversified portfolio yourself by buying individual companies across different industries. Think of it like this. Don't put all your eggs in one basket. Cost. Generally, ETFs have lower expense ratios than mutual funds. What's an expense ratio? It's basically the annual fee you pay to own the ETF. Lower fees mean more money in your pocket. Trading. ETFs are traded on stock exchanges, just like individual stocks. This means their prices fluctuate throughout the day, and you can buy and sell them whenever the market is open. Mutual funds, on the other hand, are priced once at the end of the trading day. Investment minimums. Some mutual funds require you to invest a minimum amount of money to get started, which can be a barrier for new investors. ETFs usually don't have these minimums, making them more accessible. All right, now let's shift gears and talk about mutual funds and Roth IRAs. These are both popular investment vehicles, but they serve different purposes. Mutual funds. Remember that basket of stocks we talked about with ETFs? Well, mutual funds are similar. They pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers who make investment decisions on behalf of the investors. Roth IRA. A Roth IRA is a special type of retirement account with some awesome tax advantages. You contribute money to a Roth IRA after you've already paid taxes on it. Then your money grows tax-free, and when you withdraw it in retirement after age 59 and a half, you don't owe any taxes on those withdrawals. Pretty sweet deal, right? Taxes. With a regular mutual fund, you might have to pay taxes on any capital gains, profits from selling investments, and dividends, payments you receive from companies. But with a Roth IRA, your qualified withdrawals in retirement are completely tax-free. Contribution limits. The IRS sets annual limits on how much you can contribute to a Roth IRA. For 2023, it's $6,500 if you're under 50. Mutual funds generally don't have contribution limits. Investment choices. Mutual funds offer a wide variety of investment options, allowing you to invest in different types of stocks, bonds, and other assets. With a Roth IRA, you have flexibility too. You can invest your Roth IRA money in various assets, including mutual funds, ETFs, and even individual stocks. Mutual funds. Mutual funds are a solid choice for long-term investors who want professional management and diversification. They're a good way to build wealth over time. Roth IRA. A Roth IRA is a must-have for retirement savings, especially if you expect to be in a higher tax bracket in the future. By taking advantage of tax-free growth and withdrawals, you can significantly boost your retirement nest egg. Outro music. And there you have it. Finance insiders. You've officially leveled up your investment knowledge. Remember, the best investment strategy for you depends on your individual goals, risk tolerance, and time horizon. Don't forget to smash that like button if you found this video helpful. Subscribe to Finance Insider for more financial wisdom, and hit that notification bell so you never miss an upload. Thanks for watching, and we'll see you in the next video.